Finishing up, capitalism is society, putting integrity into finance is purely a positive phenomena. Also, putting integrity into media. Indicators of lack of integrity in the governance and management of financial firms, or insert your industry here, and their advisors. These indicators of lack of integrity include those professional firms who serve both the supply and demand side of the financial services. Specifically, this includes law firms, banks, investment banks, brokerage firms, accounting firms, and consulting firms, especially compensation consultants, as well as other financial service firms, including mutual funds, hedge funds, and private equity funds. For managers and directors of financial firms and their advisors, Forrest Moser, 2006, in his speech Integrity in Finance given to the Swiss Banking Institute, offers some all too common explicit indicators of the existence of the out of integrity behavior in their organizations. Everyone else is doing it. We've always done it. This is the way this business works. If we don't do it, somebody else will. Nobody's hurt by it. It doesn't matter how it gets done. As long as it gets done, it works. So let's not ask too many questions. No one's going to notice, and besides, we will fix it before they do. It's legal, but it's too expensive. It has to be done to save the organization. And by the way, a lot of jobs, because the widespread lack of integrity in organizations reduces time, long-term value. It raises the question, how can it persist if it destroys long-run value? We address this issue in the next section. The general lack of integrity in relations with capital markets. There are many reasons for lack of integrity in relations between firms and capital markets, but a major contributor to this situation is that markets reward and punish managers in ways very similar to those budget-based compensation systems that pay people to lie. That is, systems that pay people to underpromise and overdeliver, quote. Indeed, many readers have undoubtedly heard managers and executives explicitly announce underpromise and overdeliver. As both a personal and management philosophy, it is certainly out of integrity. Stripping away the politeness, a management or behavioral philosophy of underpromise and overdeliver actually means in many situations lie and lie. I lie to you about what I can deliver, a low profit, and I lie to you about what is the actually delivered, a high profit. Another example of violations of word four, put this way, it is obvious what happens to integrity, trust and reliability in cultures where such behavior becomes generally accepted. We now turn to an analysis of one of the market forces that encourage managers to engage in gaming behavior such as under promise and over deliver. Figure one below. From Skinner and Sloan, 2002, page 209, illustrates vividly how markets reward and punish managers for meeting or beating the analyst's consensus quarterly earnings forecast over the period of 1984 to 1996. The graph plots quarterly abnormal returns for growth firms and value firms as a function of earnings surprise at the end of the quarter. Forecast error is measured as the earnings surprise relative to the quarter end stock price. Growth firms are those with high market value to book value ratios, and value firms are those with low market value to book value ratios. Data is the IBES database for the final month of the fiscal period for fiscal quarter for the earnings is being forecast. Sample size 103,274 firm quarter observations in the period of 1984 to 1986. A 1% positive earnings surprise results on an average in a 10% abnormal stock return for growth firms and approximately a negative 15% abnormal stock return for missing the quarterly earnings forecast by 1%. For value firms, non-growth firms, the comparable abnormal returns are 6% and negative 3% respectively. Managers of a firm facing these sorts of rewards and punishments from capital markets have incentives to take long-run value-destroying actions to satisfy the market's short-run expectations. Interestingly, the relation between a firm's top management team and the capital markets has resulted in an equilibrium that replicates many counterproductive aspects of corporate internal budget or target-based bonus systems. Thus, the capital markets provide further short-run incentives for managers to take out of integrity actions to meet market expectations. For corporate expectations, holding large quantities of restricted stock and stock options, Figure 1 portrays pay performance relation that defines how meeting, beating, or missing analyst forecasts affects the value of their equity-based holdings. Figure 1 has, hold please, how markets reward and punish managers for meeting or beating consensus forecasts. Okay, so this is negative 0.07, negative 0.02, Skinner and Sloan, 2002. This axis is the abnormal return and the forecast error. The same general shape as a smothered version of a typical nonlinear managerial bonus pay performance relation depicted in Figure 2 as discussed in Murphy and Jensen's 2011 and produces the same counterproductive incentives. You can rewind back to the first video we did on this for more on that. Therefore, we discuss in some detail the incentives managers face under the bonus plans represented in Figure 2. Figure 2 illustrates the common management compensation practice in which a manager's salary plus bonus is a constant until a minimum threshold performance is reached, commonly 80% of the target, or budgeted performance level at 80% of the target performance. The manager receives a bonus for making the threshold performance target. This bonus is often substantial, and as performance increases, above this hurdle, the bonus increases until it is capped at some maximum 120% of the target performance is common. Performance above this upper limit generates no additional bonus. Consider managers' incentive when they are struggling to reach the minimum hurdle. In this situation, as long as they believe they can make the threshold performance, managers will engage in actions to increase their performance, and this can be done by legitimate or illegitimate means. When the measure is profits or some variation of profits, managers have incentives to increase this year's profits at the expense of future years' profits by moving expenses from this year to the future by delaying purchases, for example, or by moving revenues from future years into this year by booking orders early, by announcing future price increases, by giving special discounts this year, or by guaranteeing to repurchase goods in the future, and so on. When these actions simply move profits from one year to another, and the adverse impact on the firm value is probably small, but it can pay managers today to engage in actions that reduce the total value of the firm cash flows by moving profits to the current period, even when future profits are dramatically reduced. Figure 2, how typical management bonus plans reward punish managers for meeting or beating internal performance targets. I didn't realize if you're on a computer, this won't work, but actually it might. It might have done it. You can zoom in and out, pause, speed up, slow down, all those things. But let's see. So base salary, incentive zone, pay performance, okay. Base salary target bonuses, base salary threshold bonuses, base salary threshold bonus, performance target performance. When managers conclude that they cannot make the minimum threshold hurdle, ooh, pause. 1 sec, hold please. Managers conclude that they cannot make the minimum threshold hurdle, their incentives shift dramatically because if the manager is going to miss the bonus this year, there is no further reduction in compensation from performance that is even farther away from the lower threshold amount, subject always to the condition that the manager is not fired. In this situation, managers have incentives to do the opposite of what we just described. That is how that that is, they now have incentives to move profits if that is the performance measure from the present to the future. They can do this by moving expenses from the future to the present period, by prepaying expenses, taking write-offs, or restructuring, etc., and by moving revenues from the present to the future. This is the Big Bath theory, and phenomenon is regularly observed when firms faced with missing analyst expectations take a big bath to improve their ability to meet analyst expectations in the future. All right, we'll continue with finally managers who are within the bonus caps. Let's see if I can do this. Okay, so we got Thurman Munson here. Light is horrendous. Nolan Ryan, Mickey Mantle, and Yankees 78. All right, peace and love. Bye bye.